When people ask me what destroys capital more than anything else, they usually expect some complicated explanation. Hidden market traps, secret manipulations, powerful institutions pulling invisible strings behind the curtain. But the truth is much simpler, and that's what makes it so painful. Capital is not destroyed by the market, by competitors, or by global crises. It is destroyed by the people themselves, by their behavior, their beliefs, their impatience, their fear, their greed, and their endless willingness to repeat the same mistakes again and again, even after life and the market try to teach them otherwise. In both life and investing, the same principle applies. A person can be intelligent, talented, educated, even brilliant, and still make terrible decisions if they cannot control their emotions. Money flows toward calm minds and quietly escapes from impulsive ones. Great fortunes are built slowly, quietly, almost invisibly, but they are destroyed loudly, suddenly, and violently, sometimes in a single day. Looking back on my own journey, I realized that investing would be remarkably simple if people simply stuck to what works. But people don't like simple answers. They want something dramatic, complicated, exclusive, something that sounds like a secret shortcut. And everyone who looks for a shortcut in investing eventually pays the highest price. The world does not reward attempts to cheat the system. The world rewards discipline, patience, and the ability to avoid doing stupid things. The most dangerous mistake an investor can make is trying to get rich quickly. Nothing destroys capital faster than the desire to accelerate results. It blinds the person to risk, deafens them to common sense, and chains them to their emotions. And every market crash, every broken portfolio, every devastated account usually begins with the same thought: this time is different. This time I'll be fast. People love excitement. They love the feeling of action. They want to buy and sell, jump in and out, react to every headline, every rumor, every twitch of the market. But investing is not supposed to be exciting. Investing should be like watching paint dry or grass grow. And if you want excitement, take $10 and go to the casino. But don't call that investing. Most investors lose money not because they choose the wrong companies, but because they choose the wrong behavior. They sell too early, buy too late, panic when the market falls, and become euphoric when the market rises. They allow emotion to dictate action, and emotion has never cared about your financial well-being. Emotion is a terrible financial advisor. Fear has destroyed more capital than any recession. Greed has destroyed more wealth than any bear market. The combination of the two, oscillating between fear and greed, is the engine of most financial disasters. Fear whispers, "Sell everything now before it gets worse." Greed whispers, "Buy more. This is your chance to get rich." Logic, unfortunately, stays silent unless you train yourself to listen to it. And the market always punishes emotional extremes. When others panic, opportunities appear. When others are euphoric, risk silently grows. But most people react at exactly the wrong time for exactly the wrong reason. They panic because others panic. They rush in because others rush in. They follow the crowd into the fire, believing they're following it to safety. One of the greatest errors is confusing price with value. People chase prices the way a child chases a shiny object, believing that movement equals meaning. They think that if something goes up, it must be good, and if something goes down, it must be bad. In reality, price is what you pay, but value is what you get. And the market is a voting machine in the short term, but a weighing machine in the long term. Most investors never give it time to weigh anything. They jump in and out, constantly rearranging their portfolios like furniture in a burning house, and then wonder why nothing improves. Wealth grows by waiting, not by worrying. Leverage is another silent killer of capital. Debt promises speed, but demands perfection. It works wonderfully until the moment it doesn't, and then it destroys everything. I've seen countless smart people use leverage to accelerate their gains, only to discover that leverage also accelerates their losses. A person with modest leverage can lose everything during a market downturn. A person with no leverage might lose sleep, but not their future. You don't need to swing for the fences in investing. You only need to avoid striking out. And leverage is the fastest way to strike out. Overconfidence is a quiet, seductive mistake. People believe they are smarter than they are, and markets are simpler than they are. They think because they had one good year, they can predict the next 10 years. They think because a stock doubled, it must triple. Confidence is important, but overconfidence is catastrophic. The market has a habit of humbling those who believe they are invincible. If you think the market cannot hurt you, you have already lost. Then there is impatience, perhaps the most universal of all financial errors. Everyone wants results now. They want progress they can see, numbers that rise quickly, charts that move sharply upward. But wealth grows the way a tree grows, slowly, silently, invisibly at first. The compounding effect, which is the most powerful force in finance, only reveals itself after years of consistency. And yet most investors interrupt compounding constantly because they can't resist touching the portfolio, adjusting, tweaking, fixing what isn't broken. They sabotage their own future by refusing to wait for it. People often misunderstand what investing is supposed to feel like. They think confidence comes from knowing the future. In reality, confidence comes from knowing that you don't need to know the future. You only need to make decisions that will remain rational across a wide range of outcomes. You don't need to predict the weather. You need an umbrella that works in any weather. You don't need to know when the market will fall. You need a portfolio that survives the fall. But most investors engage in prediction instead of preparation, and predictions fail far more often than they succeed. Emotions lead to mistakes, and mistakes compound faster than returns. A single reckless trade can erase a decade of wise decisions. A single moment of panic can undo years of patient saving. A single once-in-a-lifetime opportunity can become a lifetime of regret. Most capital destruction begins not with a lack of knowledge, but with a lack of self-control. And the market does not forgive emotional decisions the way people do. It simply takes its price. Another subtle but devastating mistake is watching the wrong things. Investors pay attention to headlines, rumors, daily fluctuations, online predictions, social media noise, everything except the actual fundamentals. The more noise they consume, the less clarity they have. The market becomes a blur of flashing lights, and they chase every light. But wealth comes from focusing on what matters: a company's earnings, competitive advantage,
management quality, financial strength. Everything else is just distraction. The more distractions you entertain, the more mistakes you make. A related error is comparing yourself to others. Comparison kills rationality. People see someone else making money faster and immediately abandon their own strategy to imitate them. They stop thinking long-term and start thinking emotionally, competitively. But finance is not a race. Wealth is personal. Strategy is personal. Goals are personal. The moment you anchor your behavior to someone else's success, you stop acting in your own best interest. And nothing destroys capital faster than trying to match someone else's timeline. Investing also